are in listen-only mode.
Good morning, everybody. It's Gil and Dr. K actually coming to you, both of us coming to you from our offices in the historical financial district of downtown Playa del Rey, California. No lie, actually. We're in a building that was built in 1906 as the first bank of Playa del Rey, and it's probably been 100 other things since then. But in any case, we like to think of it as the historic financial district of Playa del Rey, and that works for us. In any case, we're on the beach today and watching the market bounce off of what I see here is 2,900 support on the NASDAQ. And, you know, the way I look at this, and there were maybe one or two emails from people, because the model went to a sell signal. And there were some people asking why, you know, on support. What you're seeing here is you see this break and you see a bounce and you're coming up into these lows here. So 2950 looks like short-term resistance for the NASDAQ, and sure enough, it hit it today and is rolling back. To me, it looks like you're going to break this low. Now, I don't know for sure, and we're in a QE market where coming down this much, anything could happen, I suppose, but you could also break to the downside, and it looks like there's still a little bit of questionable action under the surface. So on that basis, the model is on a sell signal. Dr. K, do you have anything to add on that?
Well, not as far as you know, the report said it as it is. There's nothing to add to what I wrote into the report. And you know, right now there's a lot of selling pressure going on, not just here but in Europe. UK's declared an official double-dip recession, and countries are linked. So with UK declaring an official recession, it's only a matter of time before Europe and US potentially also have double-dipped recessions.
Right. So, you know, I think what I think is going on here is that the market is starting to discount the end of the Mayan calendar, which is I think in November. Is that right? So I think we're about right. Aren't we? We're like 6 months out from that. So I think that's what's happening. So the market is starting to discount the end of the world, and we're going to go short on that basis. Not that any of the money that we make is going to be any good once the end of the world has come. But who knows? Maybe there is an afterlife.
The wormhole tunnel is being set up right now.
Do they take Visa in the afterlife? I'm just wondering.
Wormholing.
All right. Anyways, so the way we look at it is the market's trapped in here, and at least on the NASDAQ, and you can see the other indexes. Let's take this down. Let's look at the S&P. You can see S&P is bouncing off of support here as well. And one second. I forgot to plug in a laptop, which is about to die on me. Looks like we're okay now. But anyways, you can see the S&P 500 index is also undercutting these lows here. So it's logical that you get a little bit of flip to the upside, and notice how it comes up into resistance. To me, you're going to have to make a strong move above these lows here, up through this area, to convince me that you're going to mount a meaningful rally. So if this fails, then we're probably headed for new lows. And if you're in the market direction, model your position for that. Now, the way we handled the signal yesterday is that we didn't go piling all the way in right away. We're going to incrementally move in. And we were looking for a little bounce to add today, which is what we did. And so I think for now, the market is trying to find support here at logical levels, but I don't know if it's going to happen. And I'm not looking for it to happen. So let's see. Let me go back. Let's look at the NYC, NYA, the New York Composite. Same situation here. Has undercut these lows, trying to bounce up into them, and that's now resistance on the upside. If we look at the Russell 2000, now we've chosen to play mostly the Russell 2000 here. And Dr. K, do you have any rationale?
Russell 2000 tends to exaggerate the other markets' move. So if you're right on the signal, you're going to make more on the downside on these sell signals. That does not apply to the upside because for much of this year, the Russell has been lagging the NASDAQ and other major indices. So on sell signals, we're going to mount into the Russell 2000 because we're going to get more downside. And that also applies because there's so much trouble in Europe. I did recommend the EDZ, which is the 3 times inverse global emerging markets ETF. That if you pull up a chart of that, you'll see that it always exaggerates the market's moves to the downside. It tends to be a loss leader. So on a sell signal issued by the model, on true signals, EDZ tends to do very well.
EDZ.
Yeah, and in this kind of environment, also keep in mind, with UK declaring an official recession, that only bodes far worse for emerging countries. That's simply why the ETF like EDZ tends to get hit a lot harder than other equivalent 3x ETFs.
So let me move to a daily chart here so I can look at that ETF. And yeah, actually looking very kind of viable here, coming in a little bit, so it's okay. Would you be buying this here, Dr. K?
Yeah, you could, because look at where the price is. Your risk level relative to where the model went to sell is still completely within bounds.
Yeah.
It hasn't really moved.
Yeah. No, it looks okay. Looks good here. So, anyways, and then of course we have the buy signal on the UVXY. No, I'm not shorting.
Can you do a log chart on that?
I can.
Oh, that's fine actually. Yeah.
Yeah, so you can get a better look.
Yeah.
On that. You can see you're just kind of moving up and pulling back. But I think this is buy right here, and so I would be adding or buying.
Yeah, the idea is if the market breaks, has another break, and again, the market is in a logical place to bounce here. Markets don't go straight down in straight lines, usually. Well, there's a couple exceptions to that, of course, but
like May 2010 and August 2011.
But I would say that in terms of a bounce here, it would be logical that the market might sputter around for the next few days and then head to lower lows. That's what the European markets have been doing. They've been in a nice downtrend, but that doesn't mean they go straight down. That means they'll go down. They'll go appreciably down, recover for a few days, and then set new lows once again. And that's probably based on European action and based on the linkages. That's probably going to be what's happening in the U.S. markets, because we have a lot of issues that are on the table right now. Now, of course, the one wild card against all these negative issues out there is quantitative easing. And the question is, will the markets find its footing, and will the market be given a respite for a number of weeks where there is no terrible news on the docket, allowing the markets to have a slow upward creep based on QE fueling the markets higher?
Okay, well, I was talking to a little bird this morning on my morning run, and he says we got 10 to 12% more on the downside in the index. So what do you say to that?
I want to talk to this bird. What's his track record?
No, actually, you know what happens in the morning is I go out and these birds get in front of me and they all start running in front of me. So I got this gaggle of birds in front of me, and what they're doing is they're trying to lead me away from their nests. And they'll stay in front of me, literally running on the ground in front of me, say 10 feet in front of me, and looking back over their shoulder and making sure I'm following them. And then at some point, when I'm about 50 feet away, they take off.
They're more clever than us.
I think birds are a lot smarter than people give them credit for. So at least they're not deep in debt. So in any case, let's look at some situations I'm dealing with. Right? For all you know, what is intelligence?
I mean, look at these countries. How many countries are leading countries are all in debt.
Yeah, what is intelligence anyways? I mean, humans so smart, look where we've gotten ourselves. The animals all seem to be okay. But I don't see any of them worried about making mortgage payments. In any case, what do we got here? We're looking at Netflix. Now, you guys all know from last week that I was shorting Netflix, and I'm still short Netflix. And as I see this is a descending base. Well, I don't know what you want to call it, but it's just moving lower. And again, you have what I'm calling an SGD, Sam Gopher David, shortable gap down. And this is something we're looking at. But I think in most cases, if you have a situation where you have a good pattern in terms of a weak pattern, and you see the thing gap down to the downside, and it's coming out of what you might call a deconstructive pattern. In other words, a weak sort of consolidation that's consolidating, a bounce, which is what happened over here. And now it's rolling over again. And when you have these gap downs, I think they're shortable. So, that situation comes into play, and some of these other names I'm looking at. Now, CF is a short on the basis, here's a late stage base, and you have a breakdown through the 50-day, but I think you're headed to the 200-day moving average. So at this point, this could bounce off the 200-day, and then you have a period where it goes sideways, bumping into the 50-day. I'm short this right now on Monday on this bounce here, but it did try to hold up yesterday, but the next day it gaps down and goes lower. That's telling you these things are weak. And I think this is headed for this low and the 200-day moving average. Also, keep an eye on the cloud stocks here. I think F5 is a short right here, using the 50-day as a stop. I think this thing is headed down for the 200-day moving average. But First Demander cut these lows. Let's see here. Also look at CRM, another situation, and these are all, this is really busting hard, and you can see how you go through the 50-day late stage pattern and kind of a pod. These are punch bowls of death, because all these big, what I call the power trio of cloud computing stocks have all started to roll out of these pod-like formations. And what I'll do here is let's put up a daily chart on one side and the weekly chart over here on the other side. So it might look a little weird. But let's see. Okay, so you'll have to deal with some of the background. But anyways, so where do we go? There we go. So you see this thing breaking down, but here's your pod formation. Let me try and shrink this, and let's just go big here. This is kind of a big pod type formation, straight down, straight up, and you're rolling over and you're busting wide open. So the whole group is starting to go VMware, probably doing a similar sort of thing, probably in a better shortable position, although your upside risk from here is a 50-day moving average. But I think a lot of these are headed for the 200-day moving average before they roll over. And the one that I've chosen to pick on is F5, which I was shorting yesterday. Even as the market was trying to rally, I still think this market's headed lower, and I think you're starting to see it in a lot of the stocks. Now, there are some exceptions. Of course, you know, LinkedIn was trying to issue a pocket pivot the other day, and it's kind of a bizarre kind of. Dr. K, is that really a pocket pivot, or what is that? Or it's just a reversal pocket pivot? Is that a powerful situation? A funky situation?
It came off so hard. Situation? What is it? It came off the Bible gap up there. And as we all know, with Bible gap ups, you sell if it undercuts that low by more than a couple percent. So you would have been selling the next day, and then it comes all the way back down into the base, and then rallies all the way back up. That's a lot of volatility, and therefore it's not the kind of pocket pivot that I would just dive right into. It is technically a pocket pivot, but there's a lot of volatility there, so you have to be, if you're going to play that one, play it with half a position at most.
Yeah, and I think you have to take into account the general market environment. So, I like the turnaround. I bought some shares, but I just split them out for a little gain there and not much more. The one thing that bothers me about this gap up, and this is my view, mostly I think, is that you have 1, 2, 3 gap ups in the pattern on the way up, and I think by the time you get to the third gap up like this in the pattern, it becomes a little obvious, and you do actually see a number of these in other stocks where there's a similar situation, and I think like Biogen was back. Let's see if I can back in here. We have one, and then this second one becomes more. Was there another one in here? I guess not. But
that second one was.
But still, just way too extended. So the whole point is when these things kind of get extended to the upside, and you start to see, well, here's another one, here's a third one, and of course that one doesn't work. So they start to get a little bit too obvious, and I think they're traps. They're bull traps rather than viable gap up. So be aware of a stock when you're buying a viable gap up. How many has it had? Where are you in the stage of the market? And where are you even in the stage or the position of the stock within its overall price move? And so when you look at something like LinkedIn, it's had a sharp move off the lows. And for all we know, maybe this is going to be an IPO pod, a punch bowl of death, because you're straight down and straight up, and it's starting to meet some of the requirements. But you'd have to break down through the 50-day moving average and start to bust apart, similar like you're seeing with CRM, F5, and VMware also. So you saw racks getting hit, and that's doing a similar sort of thing. Maybe this is a pod, you get a breakout, and now this is failing. But you're seeing this, and it's getting more widespread, and I think that's what tells you the market is going to get into more trouble. But again, like Dr. K says, there's always this random QE thing out there, and I got to tell you, being short, what keeps me up at night is I have a nightmare of Ben Bernanke's shiny face smiling there and telling us that not only is he instituting QE3, but he's going to throw in QE4 and 5 just for good measure, and the market gaps up 700 points on the S&P 500, and I get killed. So that's kind of my nightmare on the short side, or the thing that the boogeyman that keeps me up at night. In any case,
he could pull a Roosevelt as well and set the price of gold. Fixed price.
Yeah, exactly, which is what they did in 1934 when they said, oh, we're going to pay you $20 and I think it's 56 cents, right? I wonder where they come up with that number. And they take everybody's gold at that price and then declare the price to be was $35
It
an
was an
ounce.
instant devaluation of the U.S. dollar
Right.
overnight in one fell
And
swoop.
they created a, from that they created a $52 billion slush fund that was, I believe, called the Currency Stabilization Fund or something like that. But you know, the world went off the gold standard for the most part around World War I, and a lot of the debt that was used to create the bubble in the 20s, the Roaring 20s, was a result of some of that. And so you know, we're back. We do the same thing over and over again. At some point, it all blows up. Maybe this is a time. Who knows? Or maybe it's not.
Keep in mind, though, from history that in June of 1932, the market went into had its biggest bull market in a matter of months. The Dow went over 100%, and that's simply because of these policies, these money printing policies that were enacted. You know, essentially pegging the price of gold to a fixed amount, a fixed dollar amount, is a great way to instantly print, you know, devalue the dollar. So you're effectively instantly printing all this money. And then the markets went into a big bull from, I think it was 1934 to 35. So from that, in a market sense, in a stock-related sense, what Roosevelt did was incredibly bullish for the market, and it did cut short the Great Depression, where the Dow lost more than 90% of its value from the peak in 1929 to the trough in June of 1932.
All right, let's go through some questions here. People are asking about. Let's see. Daily chart up here. Tractor Supply. I mean, for the most part, I would be taking profits on stocks and backing away. So I'm not really interested in being long. So you know, there's not much I can tell you here, other than you're still holding the 50-day moving average. You're still holding this gap up, and that's about it. And you should be able to figure that one out on your own. There's nothing special here that one might see, you know, other than maybe some support off the 50-day moving average. But this could continue basing for a period of time before maybe going higher. But it's had a long move too, so you got to kind of keep that in mind, I think. Let's see, Z for Zillow. Zillow's holding the Bible gap up, so that's all it's doing. It's just holding the Bible gap up. So if you're long it and you don't think the market's in trouble and you want to hold the stock, then of course what are you doing? You're just using the low of the gap up day here, which looks like 37.97 as your downside stop or your guide for a stop if you're adding 1 or 2 or 3% for downside porosity. So that's really all there is to say there. Let's see. Sound is good, somebody says. Well, we're actually in the office using a cheesy and very old Logitech microphone camera. So V short here against HOD high of the day. Let me see. Well, V is kind of looking like a late-stage failure here. Now, the nice thing here, I've actually been looking at this as a short too, but it's a big stock. And I'll tell you what I tend to like to do when I'm shorting with QE around is I like to avoid stocks that are probably big index stocks or big market stocks because they will tend, if the market starts to rocket to the upside, it will tend to move with the market. And I notice when the market starts to rally, you don't necessarily see a stock like Netflix or F5 start to push up very strongly. So, you know, I don't know if that's just my imagination or what, but that's just my own preference. There's plenty of targets out there, I think, and so I'll go for those. But I think you can also go for this one if you want to use the high day as a stop. Yes, that would be a logical way to do it. 50-day moving average doesn't seem to be able to get through this area, so that's viable on the basis of it being a short, not a short, but a late-stage failed base. And usually what happens is you get a sharp breakdown through the 50-day and then a snapback rally, and then it spends a bunch of time going sideways as it prepares to roll over again. Would you call Russell 2000 a head and shoulders? I don't really know. You can look at the market and maybe it looks like a head and shoulders, but we don't really use that pattern on indexes because if you go back, and let me just go, I'm going to use this. If you go back to 2010, and let me see, where are we here? I remember going to a party and there were some old O'Neill institutional salesmen, these older guys, like, you remember Bruce Hamley, right, Chris? And he was going on and on about, you know, the market's in a head and shoulders, and here you can see the NASDAQ is in a head and shoulders, you know, and who's to dispute that? There's your left shoulder, your big head, and your series of right shoulders. And right about here, I was at this party, and here hearing all about this, I thought that's probably going to be the bottom of the market here, and sure enough, the market turns around. So here's a head and shoulders. It doesn't mean diddly squat because the market turns around and takes off on a big rally in September 2010 with a big follow-through day here, and you're off and running. So I wouldn't pay any attention to head and shoulders or even get hung up on it. Just watch the stocks, watch the short sale targets, and watch the distribution in the market and in the general market indexes and what the market direction model says. So in terms of generating a sell signal. So, I mean, it seems to me, and I know some complain that maybe it's a little late. It seems like it lags, but I think part of that is, and Dr. K, feel free to chime in on this. I think that it's because it mostly moves on the basis of strength on the upside and weakness on the downside, which in a QE sort of market is more of an oscillator phenomenon. When it looks really ugly, it tends to turn and rally. When it looks really good, it tends to drop back in. And it may be more a function of the market environment that we're in. So that's kind of how I look at it.
Yeah, it's been that way since early 2009. At least, as in that one report I wrote, most of the pullbacks have been contained within, typically 5 to 8%.
Does the VIX influence the market direction model in any way? That's one question we got here.
No.
No.
Now the MDM stands on its own. The TVIX UVXY model, on the other hand, of course, is utilizing various other indicators, and it's a much shorter term regression to the mean and trend following model. So the number of signals issued by call it the UVXY model, because I prefer UVXY, the number of signals should be quite a bit larger. It should be about twice the number of signals that the MDM issues.
Okay. And yeah, they're two separate models. Keep that in mind. And one does not, somebody was confused the other day thinking that the TVIX sell or buy or whatever was also an MDM signal, but it was not. And also keep in mind it's a work in progress. And so if you're using it, use it at your own risk. So
yeah, we provide some guidelines in terms of the, obviously the most valuable statistics are the drawdowns, the biggest loss per trade, and then the new fail-safe that's put at 19%. On our recommendation that people don't put in any more than 10 to 20% of their account in a TVIX or UVX instrument because of the nature of its volatility. And so a 19% loss would represent 1.9 to 3.8% to an entire account. And if that's within, you can dial it up or dial it down as you wish. And of course, as the signals start to come through, my expectation is that they will uphold what I've witnessed in the back tests. So over time, my expectation is that this model is going to be a top performer, but let's see. But time will bear that out.
I suppose it will. So I should remind everybody, when the model is issuing or misfiring and getting a series of bad signals, you guys don't have to email in and give Dr. K a bad time, because you can rest assured I'm giving him a very, very bad time.
But I gotta say, virtually, even though the models had a lot of, it was like June, July of 2011, we only got just a tiny trickle, and I wouldn't even call it a trickle, of issues with the model. And then, of course, August came around, and so anyone who left, then was even doubly upset because then they missed all the true signals. And this go around, I'd say it's kind of a repeat of June, July of last year in terms of the the very, very few emails we get that are discussing concern. I do try to address concerns in the write-ups, the reports that I send, so if people understand we're on the same page, that we are all on the same page in terms of our understanding of the model and the market environment.
Yeah, and it's the illogical limitations as well. It's not a panacea. So I like to give Dr. K a bad time and call it the statistical hubris model. That the idea that statistics can solve every single problem, and I don't think that's the case. And I really don't think that's how the model's intended. But I do like to just yank his chain on that. Although it's, your chain is hard to yank. But most people, it's very, very hard. I mean, I can reply.
I know you got frustrated. It was a couple of years ago. You were really, and it had nothing to do with the markets, by the way. It had something totally irrelevant. And I remember I didn't even respond. And I didn't even, it wasn't that I was trying to be silent. It was sort of like, oh, whatever, I didn't even really care. That pissed you off.
I could get a reaction. Not like, I don't know, I got an email this week from some guy, because I thought the follow-through on the S&P 500, 1.36%, I mean, the market direction model went to a buy signal on that, and so did Investors Business Daily, and everybody knows that's where our old boss is, Bill O'Neill, our old mentor. And so I basically called it, trying to make a silk purse out of a sow's ear or something like that. Is that right?
That's right.
Yeah, and really that comment was directed towards you. Okay?
That's right.
But I get an email back from somebody who's outraged or they're upset, and it's a reflection on my poor character, my poor character, me, Gil, that I would deride my former mentor and a man who's responsible for. It's like, dude, chill out, man. It's like.
That's taking things a little too
I just,
serious.
but it's interesting how you can get somebody really riled up, and so I guess I'm just going to have to pick on the webinoids out there. So somebody asked a dumb question.
But you know, before we go to this question, it's interesting because I got an email. Sometimes I get very interesting emails that shed light into people's perceptions. And one of these emails recently was it read essentially, I'm paraphrasing here, that IBD's big picture has been right on the money for the last year. And I'm thinking, wait a minute, if you look at most of the signals, if you look at the five follow-through days in 2011, 4 of the 5 were false signals. So where does he get off saying IBD's been right on the money? And then, of course, you know, the last signal was also a false one, but most models have been having a tough time.
Yeah, I mean, I think
last
year
I'm not
was
criticizing IBD, but I am saying that someone who's thinking, you know, Bill O'Neill could do no wrong, and IBD's been right over the last year. I mean, God, that is so off the mark. It kind of was dumbfounding to get this email, and of course I set the record straight specifically, and then the person then I assume absorbed what I said.
Yeah, but I mean that doesn't mean we didn't give him a bad time. I like to think I'm one of the few people on the planet who he's hung up on in a phone conversation when I work for him, and I got into a lot of trouble when I was at O'Neill because I got a hold of a Star Wars Yoda doll, and I kind of altered it a little bit to actually make it look like Bill. And
there is a bit
some
of
people, Bill sounds funny, but some people were offended within the office. But anyways, that's whatever. You know, we're just trying.
Bill's
to
a very
fun.
charismatic guy, but of course it's a caricature, and caricatures are supposed to be funny.
Yeah, because he was the master, Yoda. So anyways, whatever. But some people just thought we were insulting Bill. But anyways, whatever. Okay, somebody asked a question, is rack shortable? Well, here's is this a shortable gap down? Maybe it is. So I think you could try and short it, use a high of the day as a stop. You got the 65-day exponential here. You notice it found support right at it, roughly, the magic moving average. But again, I kind of look at this as a zone between the blue 50-day and the black 65-day exponential. So you're rallying back up into it, 3-day rally after this gap down. I think it might be shortable here if you want to take that shot. So, you know, there's more of these showing up, and you'll notice that they show up pretty quickly. It takes 2 or 3 days before patterns start to break down. Your initial short sale targets begin to occur in stocks that are having late-stage breakout failures, or in some cases just breakout failures. It's debatable, I suppose, whether RAX is in a late-stage base or not. It has had a big move. So, you know, is this a reset? And you're real nice and tight in here. So is this a second stage base and it's just going to form a base here and maybe bounce off the 200-day? Maybe. But I do think that it's shortable with the idea that it's either going to undercut this low here, which I think is, what, 49.04, or it's going to head down to 45.28 on top of the base here and the 200-day moving average, which looks logical to me. And if I was shorting this thing and trying to work a core position, I would probably use it as my target. You know, right now, you guys know from last week, I'm operating on the basis, whoops, wrong stock, that Netflix is headed for this low. Okay, so I'm trying to hold a core position, and every day if it rallies intraday, I'll go ahead and add to it intraday and come and sit on top of it pretty heavy. It's trying to get some support on top of this little area. My guess is it's just bouncing. It's going to break down. If it starts to rally, maybe up through the 76 area, then I'm probably running for cover in the short term. But that would roughly be the high here, 75, 76 on this weekly bar, and so that's kind of what I'm looking at. But you know, look at GMCR, Green Mountain. This thing rolled over, and they kind of made a little mini head and shoulders, you know, as part of the right shoulder of this big pattern. And you can see here's the initial head and shoulders here: left shoulder, head, right shoulder, kaboom. And then you make the series of right shoulders. So this, to me, now you're in these second stage patterns here, where they can now break down from where they are. So here I see Netflix is potentially being able to move below this low eventually, okay? And so that's what I'm playing for, and obviously I'm in this earlier on the gap down move, the shortable gap down, the SGD, and and so I think a lot of these you can look at them. But as long as you find, if you see a pattern breaking down, now, you know, don't get all excited and think it's going to break down and you get a score right away. Sometimes these things will drive you nuts for several days before they break, so you have to have some persistence. And I know that for some people, if you're not using mark-to-market accounting, or if you're not listing your income as Schedule C as a professional trader, and that's the thing that I do, so all my losses and gains are counted as regular income, which doesn't matter anyway since they're short-term, and capital gains, if they were, and they'd be taxable on that basis anyways. But you got to be careful on that if you're getting wash sales, and there's no way around it. Then I don't think you can really get into a short sale methodology that requires a fair amount of activity and taking a lot of small losses. So something to think about. Don't ask me about the tax ramifications. I'm not a tax accountant or a tax lawyer, and although my accountant will tell you I'm very good about giving him all the documents he needs and being complete, I don't know diddly squat about taxes, other than that I pay too much, and I pay much more than my fair share because I ain't getting much from the government, I'll tell you that much. Anyways, that's my rant for the day, you guys. GNC had 3 gap ups, which proves my point about 3 gap ups being suspicious. Well, yeah, I guess there are exceptions. So, you know, you have, but same thing here, 1, 2, and here's a third one. This one kind of flopped out, and is it going to work? So far it's hanging in there, so, but it wouldn't surprise me to see it maybe back in if the market comes in. But again, yeah, 3. So if you bought that, you know, you probably, it looked good for a few days, but it starts to wobble in here and maybe even shook you out somewhere in here on the move below the intraday low, the gap up. So anyways. LinkedIn will benefit from the Facebook IPO. All right, Dr. K, here's a good one for you. Yesterday, Facebook filed, again, showing that some of their users are declining or something like that, and so their earnings per share are not all that great, and they're coming out of, what, 26 bucks a share, something like that. I don't know if it's going to benefit. Maybe it already has. Maybe the Facebook IPO turns out to be a big flop, and it opens up and does what Baidu did, has a wild day, and then spends the next year basing. So I wouldn't assume anything about the Facebook IPO.
Keep in mind, it's a function of the market. I was on one of those programs. It's kind of a nice thing to not remember which program you were on, but because there was a few that I did. But I mentioned that Facebook is treat it like you would any IPO. I mean, eBay was an amazing IPO. I remember seeing the Red Herring, which is the booklet they issue before the company goes public. The prospectus. And it was an amazing concept. I'd seen this concept before, but they did it in spades. And well, guess what? eBay lost about half its value from its opening price over the ensuing 2 or 3 weeks, simply because we were in the throes of a bear market from September to October of 1998. So these IPOs, it doesn't matter how great they are, they're going to correlate very highly with the direction of the market, in probably by a factor of 2, 3, or 4 times. So treat Facebook, wait for Facebook to set up properly and issue a pocket pivot before you even think about touching the stock.
Yeah. But I don't, is it going to affect LinkedIn, though? If Facebook's a hot IPO, is LinkedIn going up what?
Yeah, there could be sympathy plays with LinkedIn. When it was, I was on Wall Street Shuffle talking about LinkedIn. I mean, we sent out a report because it's a viable gap up. However, I also expressed concerns that it's no Facebook, and it's a follow-on. I mean, it's not, to me, it's not the leader in social networking space. And now with Facebook IPO coming on, if you're going to play social networking, wait for Facebook to set up and play that. Don't play LinkedIn. That's going to be a second-rate stock. And we all know second-rate stocks can benefit in a sympathetic manner, but they're not going to lead.
Okay. How about Monster? Somebody asks, is it turning sexy on us? I don't know. What defines sexy? I think we have very different definitions on that one, don't we? But I think is Monster sexy? Is that a viable gap up?
It's been a great stock. It's done no wrong. It's like an Apple. It's really it's a great leading stock, and it's had a viable gap up here. We should probably send out something on this.
Yeah, I mean, you could buy it and use a low today, 71.18 as your stop, a couple of bucks lower. So it's definitely within reason. But
yeah,
again,
I'm going to send something on this.
Again, though, I would keep in mind though that let's see, second one. No, there's nothing wrong with it except the general market. So that's about it. But you have a clean and close stop on that one if you want to try it. So, but I think the market's going to reverse on the day. The Nasdaq's already reversed. You're down 1040 right now in the Nasdaq Composite. The NDX down 1329.
Looking at some of the big stocks, you can see Priceline is down 32 bucks, 4.59%, and well, Apple's holding up still, but not much of a bounce. When you'd be looking for some power, but it looks to me like it's trying to build a base, so that looks fine. But I can't say, you know, you violated the 50-day moving average here, so you probably should have been out here on the 10-day moving average violation if you own the stock. And look at, if you had done that, you'd be out here, and you're doing fine. Forget about this, you know. A nice gap up on earnings becomes a little bit obvious. It's not a viable gap up either. And notice how it is holding the 65-day exponential moving average, the magic moving average. Someday I'll get Dr. K to change his entire system where he's using only the 22-day and 65-day exponential moving averages.
Oh, yeah, we need to talk about that. You know, give us any set of tools, Dan Morrison, give us any set of tools, we'll figure out a way to make money off them.
Yeah, that's true.
It might not be optimal tools, but
I think in some cases they can be optimal. But you can see a lot of times, like look at this example, LQDT. Somebody's asking about that. You know, it's just hanging up. Bible gap up here and still holding up, so that's fine. But notice how, what I noticed is that the 65-day exponential and the 50-day moving average, simple moving average, they tend in most stocks, if they're pretty smooth, to coincide, and so they always create this little zone in between. And if I could color that in, I could create my own Ichi-Gilmour cloud patterns here that you could use as support or resistance zones. But you know that's and I think a lot of the difference between these is that the 50-day is simple, so it equally weights all the price action over the last 50 days, whereas an exponential weights the more current action. So in stocks that have had a sharp move to the upside, such as Apple, at some point they start to diverge, and the 50-day might be too high given the sharpness of the move, so that the 65-day exponential starts to move away, and that becomes an area of support. Whereas with the stock like, say, MNSP, I'm sure that the two, it's pretty steady and slow. You can see that they tend to track together, but you can tell that as they start to get further and further from each other, they'll start to spread the stocks getting a little bit wider and a little more volatile. So a lot of times the two will start to move apart, and that tells you when a stock might be getting a little bit long in the tooth. So you can see that happen here, where it's starting to widen. And I really don't know if there's anything to that, but there's just certain things I observe about the two moving averages because I kind of use them in tandem when I'm shorting, and as my short sales zones or areas to short into on rallies. And that's not more an art, I'd suppose it's in a science. Have you considered something for shorting similar to the Pocket Pivot email, something like a short selling email? A couple of things. If I see a setup that I think is very ripe, we talk about it. I think the short side is very dangerous, so in this kind of QE environment, I don't really want to be out there telling everybody to do this, do that, do this, do that every other hour of the day. I think if there are some setups, I'll talk about them in the webinar section because I can discuss them in more detail and kind of outline what you need to do to handle these correctly without getting your head handed to you in terms of setting targets. So I don't think I want to get involved in that because we haven't really studied inverse pocket pivots. And the bottom line was shorting.
I've looked at them. When I was doing inverse pocket pivots, just they don't have the risk reward that I've been able to get my head around. The risk is too great. There's too much volatility on these reverse pocket pivots. Now, on the other hand, there's a couple ideas that we talked about earlier today that might be worth looking into in more detail. That involving gap downs.
Right.
And what to do with them after the gap down, and how to if there's a higher probability of further failure after a gap down.
Okay.
Intuitively, it makes sense that there would be.
Let's see. So, what are your thoughts on LQDT? Didn't I ban that question? I never asked what are your thoughts. I mean, what is there to think? The stock's up, market's flopping around. It had a Bible gap up, and it's holding above the low of the Bible gap up. So not much to think. So I don't have any thoughts. I think I would banish that whole thought from your mind that you have to have thoughts about things when they're acting okay. It's nothing to think. Don't think. Open shortable. These are. I noticed open is hard to borrow. I was looking at soda too. I think it's a short if you can borrow it. I think you short it here, and I don't see it getting too much past today's high. Maybe up into this area, but you can also see this is a big. Here you had a head and shoulders, and it broke down, and now we're getting into this sort of big, what I call the macro pattern. Let's see if we can get it all in here. You can see that came public here, and you're kind of now in this big giant head and shoulders thing. And I think, again, this is your second stage position, and I think you're heading for this low. In the meantime, getting low bounce, I think it's short into it. So another one I was looking at too, and waiting to see what happened on earnings, and of course the stock rallies right up into the 200-day moving average. This might be shortable in here. I keep an eye on this one, but I'd like to see it. I got to take a look at this. I haven't looked at it yet today. Let's take a look on the daily chart. You know, it's holding in tight, so I'd like to see something negative or some sharper break back down even below these moving averages, or a weak rally that starts to roll over through the 200-day moving average. But right now there are better targets or other targets to focus on, so I don't really look at this one because the earnings on this blew out the shorts. And one thing to keep in mind, there's something like 6.8 days of short interest, at least by the last reported period. And that's something like 9.52 million shares sold short on a 60 million share float. So, you know, they got 60% of that stock sold short. And so just let them make bread from the bones of the shorts here while this thing works itself out, and then see what happens. I noticed that you can't borrow it. I was trying to borrow it when it was yesterday when it was hitting the 200-day moving average. And I couldn't borrow it. So that tells me that, you know, with all that 9.52 million shares sold short, there's too much borrowed and it's all taken up. But I think you might keep an eye on whether, you know, it becomes easy to borrow, then that tells you they've run all the shorts out. But the pattern looks weak. This move is too strong. I need to see it weaken first. So I think I have better targets in that regard anyways. So SWI. Solar Winds is still holding the gap up. It's making a run for the low there, so we'll see what happens. I don't know, not much to say. What's your stop? Dr. K, would you speak a little louder, please? Oh,
like this?
that's what somebody is asking you.
How about
I don't
this?
know. Dr. K, which tracks the VIX better, the TVIX or the UVXY? I don't know. Just you
Which tracks better? Definitely the UVXY, and that's just, you know, going through the short lifespan of UVXY, but it tends to track relative to the general markets more accurately. TVIX will eventually catch up to UVXY. There was a period where TVIX lost loads. It was, I think, in March. Over a 3-day period, it was down double digits every day, simply because prior to that action, it wasn't down very much. UVXY, on the other hand, had a concerted downtrend. So that was TVIX's way of catching up to fair value with UVXY. As I don't like that kind of, you know, in terms of the model was short that whole period, so it didn't matter whether the model was invested in UVXY or TVIX. But obviously we want to minimize those kinds of aberrations. So you can see there that UVXY has a nice normal downtrend, whereas TVIX had a delayed downtrend, where it actually was in a little uptrend there, and then it got hammered.
I don't like that ETF. I prefer UVXY if I'm going to trade that. Let's see. What else here? We discussed price targets for CRM. Well, if you're going to short this one, your price target would be the 200-day moving average, first of all. So that's really what you're looking at. You would expect some sort of a bounce. Might go through it. So usually what I'll do is when you come down to this level, let's say I'm keeping a core position of, well, let me put this in more normal terms here. 20% core position short CRM. Intraday, I'm going to quadruple that, take it up to 80%. And then I might cover back down to 20 or down to 10% here back to my normal position, or even take part of my core off the table and then hang with a small position, see if it bounces, and then try to put it back out, and then it breaks the 200-day. But a lot of times, like I was saying earlier, a late-stage failed base will break down, bounce off the 200-day, go through the 50-day, bounce off the 200-day, and then spend a lot of time just going back and forth. And you can look at examples of those where that happens. And I would look at a lot of the materials and the stuff stocks back in 2008. the way they broke down, and they take a period of time. And a lot of times, the late-stage failed base can also be the right side of a pod. So that's what we're looking at here with CRM. This is like a big pod type thingy, and it's breaking down at the right side. This little base becomes a late-stage failure, and so it's kind of morphs into both patterns at the same time. So that's really how those work. So a lot of times on these late-stage failures or these pod breakdowns, the first thing you're looking for is a bounce off the 200-day moving average. It doesn't mean you're necessarily going to get it, but that is what you're looking for as your target. So the other thing you can also do when you're shorting is just tell yourself, I'm willing to take out a certain percentage out of this. I'm looking also at the potential just using points and trying to think of the short side. Since the short side seems to come in very short bursts and you can make money quickly, thinking more in terms of taking points out of stocks rather than percentages and thinking in those terms and what is your objective. So if you can come in on a single day in short F5, on one day, and the next day you're taking out 5, 6, 7, 8 points out on it, you might consider taking a profit just on that basis. So, and usually what happens is you'll end up with a handful of 5 to 10 stocks that you're just going to pick on throughout the bear market. So in May of 2010, when I made not quite 100%, maybe it's closer to 90 in 1 month in my account shorting, I basically picked on X, U.S. Steel, RIM, Research in Motion, and I think the third one was Freeport-McMoRan, FCX, and it's basically those 3 stocks, and most of it I think was X and RIM that helped do that. And so what'll happen is you'll work on 2 or 3 or 4 or 5 situations, and maybe another 2 or 3 or 4 or 5, and you kind of get a feel for them, and that becomes your short list of short sale targets, and you're just working those throughout a bear market. And you have to understand that stocks will break, and then they'll rally, and then they'll break, and they have all these movements on the way down that you kind of have to dance with, and so that's what makes it more difficult. And if you definitely want to get a headache, it's a good way to do it. So, I mean, the other option, just go to cash and don't even worry about it. Lulu. Somebody asked me if Lulu's breaking down on the base. That could be a late-stage failure, yeah. I mean, you could also argue that this was this is a weekly chart here, that this was a first-stage base, given that you undercut all these lows and shook everybody out. Or you could just say it's a big, ugly, sloppy base, and that's a late-stage failure here, now it's busting. But again, you get the same situation as you do with this, where if it starts to break the 50-day and it's just barely doing it now, you might hit this here and use a high today as your stop if you want to hit it quickly. And of course, you're looking for that 200-day moving average as being your ultimate downside target, at least for the short term. So because it's usually where they'll go. Has the recent blowout of issues like Priceline, fossil wrecks, etc., changed the base character of this market towards a more significant correction, more than 8 to 12%? Well, as I was telling you, the little bird that I talked to this morning told me that we're coming down another 10, 11%. So, I think right now we're on a sell signal. The market's acting pretty weak. You're seeing more stocks breaking down, late-stage base failures. I think you have the potential to move lower, and that's where I would be leaning right now, and that's where I'm leaning. And I might have profitably so, but, we'll see how this goes. There is turf around Bill O'Neill that many at IBD lay claim to, and if you tread on their turf, they lose their minds. I can attest to that. Who is that? Oh, yeah. Yes, you're right, John. It's a bizarre place. It's probably one of the most bizarre places I've ever worked at. But in terms of a regular company, but in terms of the market work, it's brilliant stuff, and that was a great part of working there. But as far as an organization, it would be, in my view, a case study of how you make mistakes in business and how you squander what is really a very strong potential brand. I really thought the brand, the O'Neill brand, was something that could be taken a long way, but I think the organization shoots themselves in the foot. That's my view, and I would love to take that argument up with anybody in upper management at O'Neill today, but I doubt if that happens.
Yeah, I would second that. I saw a working version of Wanda. Well, I came to the company in January of '96, and I had seen at that same year a working version of Wanda in I think it was 1992. And my question was, why is it taking you guys 4 years to get this going? You could have dominated the market because this is back in the early days.
Well, yeah. I mean, we could write a book on that kind of stuff. So, should I ignore watch sale rules and re-enter a stock if it is to my advantage? If you can handle giving up that little loss on your taxes. But I would say if you can use mark-to-market accounting, and to my understanding, that is just an accounting choice. But also keep in mind that what happens to mark-to-market accounting, if you own the stock throughout the year and you never sold it, but you had 100% gain on it at year-end, that is counted towards your taxable gains. Are you seeing any stocks setting up in constructive bases? Not really. If a position, how about you, Dr. K? Are you?
Not yet. I mean, MST is perhaps the one that's been doing no wrong in this market environment.
If a position begins, I'm going to let you answer this one. If a position begins to work favorably for you and earnings are due soon, as in the next few days, does the fact that the position is working for you have you holding through earnings? I seem to remember your having said that, but do not recall hold through earnings, but I don't recall your having mentioned this in the context of working positions. If I just bought something and I'm up 5% on it going into earnings, I'm probably inclined to take that. Dr. K, what's your take?
It depends on the market environment. Back in earlier in the decade, if the stock was behaving properly going into earnings, the odds were very much in your favor to hold through earnings. You might even get a little gap up. In this market environment, it's almost like flip a coin in terms of earnings. The stock can look good before earnings and then gap down, and it can look bad before earnings and gap up. So knowing that, it's almost like the toss of a coin flip. If you're willing to take that volatility into your account, based on your position size, based on your position size, then hold through it. But let's say your average position size is 20% of your account. Knowing that the stock could gap down, say as much as 50%, factor that in. Take that into account, and then see if you might want to size back your position from 20% to something that's more palatable, say 10% position. So if it loses, say, a third of its value, it's only going to affect your account by 3.3%.
You realize you're using our accounts payable as your copy.
I know, it makes an excellent poster.
Anyways, where were we? Okay. I mean, and I would say, adding to that discussion, if I'm up 20% on stock going into earnings, then I'm probably going to sit. It really depends, and all those factors that Dr. K just talked about are valid. I think that all figures into my thinking as well. Why do you send pocket pivot alerts while we are in a correction? Because you should be keeping track of stocks acting constructively during a correction. And so since pocket pivot alerts are just alerts to let you know that this pocket pivot is occurring, that we have looked at it and we think it's viable, there are a lot we pass on, and some of them do work, even though we don't pass on, but we try to be somewhat selective. But you have to keep track of pocket pivots during a correction, because you'll notice that strong stocks will build bases and show little pocket pivots in the bases all the while the market is correcting. And that's why we send them out. They're not buy recommendations that you're supposed to just go out willy-nilly and start buying and then wait for us to tell you when to sell it. Everybody who's been on this website for a period of time understands that they're just alerts, and you have to use them within your own trading. So, our view is the pocket pivots, the viable gap ups, the short sale setups are intended for traders who are at least intermediate to advanced level, and if you're kind of a newbie, you need to be taking a lot of this real slow and perhaps adhering more to the market direction model. So we're not buying them. Let folks play their own short sales. I agree. CRM reports earnings on 5/17. I don't care. It's going lower. I'm not long it though. Wango Tango. I hate the stock. You know what it reminds me of? I mean, this thing is so volatile. Runs up, breaks down, runs up, breaks down, runs up again. Once again, there's a breakdown. You know what this reminds me of? This UVNT, this Ubiquity, which does the same kind of thing, and eventually it's going to look so good it's just going to blow to pieces. They came out with earnings. Earnings were pretty good, but it keeps acting okay. So, let's see. CYBX. I don't know, I'm not buying that. It's trying to break out, no volume. COA, I was looking at SCSS as a short over the weekend. It's a little bit early in the pattern. But you could say it's early and it's late, actually, in the sense that if this is a late stage breakout failure, then you had to be shorting it as it's up into the 50-day and it breaks down. Now you may get into something more severe where this becomes a series of right shoulders, you rally up in here and roll over again. But it's looking pretty ugly. That's kind of what it looks like. I think for now I might look at this as a head and maybe a left shoulder here and then watch to see if some right shoulders form. Coach is another one someone's asking about. So, I mean, I'm not going to short that here. They're not in the right position. Here's a good question for you, Dr. K. Okay, here. If anybody wants to have stock NB, here's one. You can envy this guy. I've been holding Monster for a while. It's about 30% of my portfolio. Really? That's like a starter position, isn't it? When a stock performs as it is it advisable to go in for a higher percentage, or would you look for other ideas?
Oh, well, that's also contextual. I mean, in terms of, if you have a big profit cushion in the stock and it's doing the wrong, my trading style is to sit with it and just let it grow as a percentage of my account. But that was, that style works very well when you have loads and loads of stocks to choose from, like we did in the 90s. In this kind of environment where you have one stock like Apple or MNST, very rare, and my inclination would be to play it to the hilt. So if you see another buy point, I would be adding to that position, knowing that I have a cushion and knowing that this might be one of the very few stocks that's actually working in this environment.
Somebody says Q-Core with a question mark. I don't care for the stock. It's too erratic. It comes up the right side. It needs more time to go
in either direction. That's a lot of trouble.
No, I don't want to short it. I want to buy it. It's just nutty.
I hate stocks that come straight down like that, and that's where you don't want to touch them. You don't want to buy them thinking it's going to bounce, and you certainly don't want to short them because they're way down there.
Why are the S&P 500 and the NASDAQ 100 so different today? They're often different. I mean, there's divergence, So if you have some of the big stocks like Priceline on the NASDAQ 100 getting hit, Oracle's also down about 3.38%. You got Netflix down a couple of
Cisco
getting hammered.
Priceline.
So that's the NASDAQ 100, and probably, are they coming to oils today or something? Let's see. Well, oils have been getting a bounce, and that will help the OIH. Let's look at the OIH here. The oils are getting a little bit, so that might help the S&P 500. So, how about some of the metals like FCX? That's getting a little bounce. So, that would be why, because there's different stocks that make up the indexes, and those clue you into divergences. So.
Yeah, and I mean, of course, the Nasdaq 100's outperformed the S&P 500 since the beginning of the year, simply because Apple dominates that index, the Nasdaq 100, and a lot of these other tech stocks follow on. They follow Apple's lead. So, the Nasdaq's been the performing champ of all the majors.
Right. Here's a question for you. Is the market direction model just a position or the entire account for size?
Oh, it depends. It all depends on your risk management strategy. I mean, that's entirely subjective. Up to each member to define that for themselves, just like it's up to each member to define what a standard position size is in a stock. Some people might only want to put 10% starting position in a stock. Other people might try their hand at 25. We have a number of members who split their account between MDM and stocks. We have some members that don't have time for stocks, so they allocate a certain percentage of capital, and that is their trading account, and they go all in on change in signals issued by the MDM.
Okay. Let's see, we're almost running out of time, so we're going to a couple more questions and wrap it up. Whoops, Splunk. Okay, what's the question here? I mean, we talked about this as one to keep an eye on. I love this. That's the weekly chart. How do I make that look like it makes sense?
Well, it just went up.
Spread out.
Yes,
this year, and it's like a 3-week pattern, so there's really nothing to talk about.
So.
This one needs some time. They got no earnings, but apparently things are going to get big for them. They're sitting on the precipice of this massive opportunity, allegedly, and so.
Yeah, they're big data.
It's something I think want to keep an eye on. Yeah.
First pure play big data stock. Their clients, they have over half the clients in the Fortune 100. So they're very well connected. You could argue that they somewhat have a first mover advantage in terms of being a pure play. So I think the opportunities in this stock are enormous. I just want to see the technical validation confirm my theory.
Yeah, yesterday I'm trying to remember the name of this, but it's another stock that somebody was asking me about, and it trades 35,000 shares a day, and they're wondering why we don't like that one instead of SPLNK or SPLK, and that's mainly because anything that trades 35,000 shares a day is not an institutional stock. So SPLK though trades, what does it trade? 200,000 right now. Whoops. To me, it looks like it's averaging somewhere around 300. That's where it's going to get to. So it's a small stock.
It's a thin one, and what can happen with good stories like this one is once you'll see the volume bars just exponentially jump if the story proves out, and so to go from being a small stock into much more liquid. I mean, liquidity in these things can go up by a factor of 10 to 30 in a matter of weeks to months if the stock's viable. Institutions will pile on.
Dean Foods is a viable gap up yesterday, I suppose, but it's a cheap stock, $13. So it seems more like a defensive move to me. I'm not into it myself. How about you, Dr. Ken?
Yeah, not my kind of stock.
Look at the gap up here. It gaps up and it doesn't really go anywhere. So you got a big gap up now. Is this going to lead to some massive price move? I wonder where this thing's
slow-moving stock. It's odds are that it's going to keep going sideways from here, and then it's just not it's not a leading stock. It's not a leader. It's not a stock that could give you good price appreciation.
No, and it seems like what's going on right here is it's just a defensive play, probably.
Yeah.
Let's see, and that's pretty much all we have. I mean, that's where we stand right now. I don't see today's bounce as being the start of anything major. I'm shorting it, and the stocks I'm short, I'm making money on. CF was shortable up here around 186. I think is where I hit it, and so now I'm just kind of letting this one play out. We'll see what happens. I think it's heading for the 200-day. You got Netflix. You guys know I've been dealing with that one for a while, and they're just working a core position. It tries to rally. I do think sometimes it might snap to the upside, but it's not able to do that. And anytime you see it rally the last few days up into this area, it was like 75, 76. It doesn't really seem to get any upside. Actually, more it's like 74, 75. Say around 75. It really doesn't get any oomph right there. So it's pretty pretty feeble. I think it's sitting on top of this support and it's just getting ready to break through. So I'm working a core position there. I'm up on it very nicely. Not quite 20%, but I'm going to try and play this out because I think you are going to break. And then we got the unholy trio of F5, CRM, and VMware. And then you can also throw in, we were talking about racks here. That's a possibility too. But some of these are early, and if you're going to work on them, those are really what you're looking for, that type of situation. I don't see a lot of head and shoulders that are in prime positions to go after them on the short side, so that may take some time to develop. And the outside chance of QE 3, 4, and 5 all being announced at the same time is always there as well. So you have to weigh that into your short selling activities. But Cash is also fine. Or you can just kind of play it soft with 20-30% positions in ETFs using the market direction model, which might make sense. So anyways, that's all we got. Dr. K, any final words of wisdom before we sign off?
No, expect more volatility. Wouldn't be surprised to see a weak bounce here, and then
well, we
should see a roll. Well, I mean, over the next, into
that
next
could last
week,
a couple of days.
Yeah, I'm kind of like, if you look at the Nasdaq chart, you'll see, when it corrects a few percent, then it stabilizes. It might go higher for a few days, and then roll over again. And again, it's a tricky environment because we have so many bad things on the table. But QE is kind of a safety net for the market. It has been that way for since 2009.
Yeah. So, all right, you guys, take care. If you have any questions, feel free and email us at info@virtueofselfishinvesting.com. All right, we'll catch you guys later. Take care.
So long.
The organizer